They're out of money. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, Burger King issues a dire warning. Bankruptcy is imminent, and they're not the only one that's flagging this. As you're about to see, bankruptcy is going to be far more widespread than most people believe. Now let's head over to Bloomberg, where he picked today's story up with a headline as Burger King to launch $5 value menu to hit back at McDonald's, and the simple reason why Americans are cutting back in a big way, as we're going to see in the months to come further increases in delinquencies that are likely to lead to bankruptcy. And here we can make the case what's going on with Burger King as a tit for tat between burger companies underscores the pressure to attract budget-conscious Americans who pull back from dining out as they buckle under persistent inflation. And what's not inflation that's the issue, and that's the problem here. Everybody believes it's high prices, and there's actually not an issue with prices rising. It's the people's ability and consumers' ability to afford them. We're going to make the case of why people are tapped out and households are going to be facing bankruptcy in a huge way. About 78% of Americans surveyed by financial firm LendingTree said they viewed fast food as a luxury, if you can imagine that, because it's become too expensive. And who would have thought that would ever be the case? What was known for inexpensive food is now a luxury for most Americans, and companies are taking note, as the chief executive officer of Burger King's parent company, Restaurant Brands International, told investors that guests have become more price sensitive, and there's a reason why. It has everything to do with wages, and yet we continue to hear from the political elites in this country that wage growth is strong and that Americans are getting ahead, and yet we are continue to hear from company after company that people are being squeezed at the margin and they can afford even less. It's suggesting the economy underneath is far weaker than most people want to admit. Even McDonald's CEO has said the Big Mac seller has to be laser focused on affordability, and yet this was a time we were supposed to experience a soft landing or no landing scenario. Americans were supposed to be getting ahead of inflation in a big way, and yet something now underneath the economy has changed, which is going to set off a long chain of bankruptcies that's going to hit during the next recession. And if you've been looking for a sign as to why this is happening, well, you can see it right now at McDonald's and Burger King. And a message on May 19th, an independent group McDonald's franchisees said the chain needed a pitch to make value menus feasible. The meal deal is affordable for consumers, they say, but not for them, as operator margins are already thin. And at $5, the bundle is cheaper than buying the items separately. There's simply not enough profit to discount 30% for this model to be sustainable, suggesting that maybe even some franchisees may enter bankruptcy at some point, as we see fewer consumers able to go out to this luxury of eating fast food. What do you think about that? Weigh in the comments. Is fast food now a luxury, or is there just something really wrong with the economy? But if there's a headline you've been looking for and make you wonder, how come I'm not making money here? I'll look at this from May 20th. Why did natural gas prices move up 16.6% last week? And you're wondering, how could I have made money on that? Well, we gave our subscribers the heads up. We told them on a report, you should be buying around here, and then again here, and then it took off. And as of close of business Friday, after two big pullbacks, look at this. This is from our CTA Timer Pro. This looks at the machine positioning. Check this out, 23.59% on then again on April 23rd, that trade up 27.31. This is less than 2 months as of close of Friday. And how do we do that? We look at the machine position. When they get into deep short positions and price moves against them, that means they've got a short cover and buy in a big way. We alert our subscribers in the reports. We show them a video. We teach you how to make money. We tell you how to do the trade setups. We include a video with the reports. And here's the best part. You can start making money now. There's a link in the description below for a 30-day free trial. Check it out and learn how you too can beat the machines. Even Van's owner, VF Corp, sells its planes amid declining sales performance. You know, when rich people start selling their planes, the economy must be in dire shape. And here's another sign of consumer weakness, as a Denver-based company has also downsized its office space to free up cash ahead of a round of upcoming debt maturities. You know, we talked just the other day about this corporate problem in, of course, this major real estate issue. And what we're seeing now, here's another company. We're going to cut back our space. That means more vacancies, less rent being generated, more office values likely to come down. You're talking about the next crisis going to be in real estate. And look at the reason why. Upcoming round of debt maturities, including a $1 billion loan due at the end of the year and $750 million of bonds due next April. What we've seen is due to this low interest rate regime, companies load up on debt. And then what did the Federal Reserve do? They constricted the creation of credit out of the banking system, which is desperately needed to pay on all of this debt and to maintain growth. What are we hearing from company after company? There's not enough money in the system. People at the bottom of the cohorts are running out. This is dangerous. When they think fast food's a luxury, you know there's a problem. That means bankruptcies are on the horizon. And VF shares fell 2.9% in New York trading this back on Thursday, closing at the lowest levels since 2009. But look at this. They disappointed investors as all of VF's major brands posted declining sales. Topped by a 26% decline in Vans. It's not just fast food that's becoming a luxury. Maybe it's shoes as well. And even Lululemon shares are now bottom of the S&P 500 as sales concern grow. And what you start to see is not only is this a consumer issue, but it's going to lead to corporate bankruptcies as well, because a lot of these companies took on massive amounts of debt. You wonder what happened at Red Lobster? Well, they sold the property underneath them, raised the rents. They couldn't actually make those rent payments. Next thing you know, store after store closes. People hit the unemployment line. It's coming in a big way. And it's a reversal of fortune for Lululemon shares, which largely outperformed the U.S. equity gauge in recent years, but a lackluster initial annual outlook and signs of softer sales trends. Again, that's not a sign of robust consumers during the retailer's first quarter, and increased competition has already pressured shares this year. And what are we seeing between McDonald's and Burger King? Exactly, increased competition. They're realizing there's fewer people that can afford the luxury of fast food, and that means they have to get aggressive to get them in the doors. That means prices get cut. That is disinflationary at the margin. That means consumer prices likely to head down. And when you see financial conditions get tight and there isn't enough money, well, there's going to be companies and consumers that fail. That's why bankruptcy courts are going to be busy. And here you can see why. When we look at total compensation, that's shown as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. And that in blue against advanced retail sales in red, both shown on a year-over-year rate of change. What you can see is decelerations in total compensation often lead to decelerations in retail sales. And it makes perfect sense, as you can see over and over, as consumers have less money in their paychecks relative to inflation. What they tend to do is actually spend less because they don't have access to the money. And now all of a sudden we're hearing this again from company after company. And there's a double whammy here because consumers are facing another problem. We can look at the personal savings rate. So even though their paychecks are shrinking, and there are times when that happens, they have a lot of savings, they dip into that, and the economy turns around. This is one time that's not happening. And the reason why is the personal savings rate as well as about as low as you can get. If you want to talk about a value meal, here it is. You can see the problem of why consumers can't afford these luxury of fast food. And what do you know? When the total compensation comes down and consumers are sitting at a low level of savings rate, they start to increase their savings as they worry about the economy. And what do you see happens? Recession, 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 a slowdown, a recession, a slowdown, a recession. A recession. You get this whole concept over and over again. And look at where we're at now. Savings rate near one of its worst in history against decelerating compensation, against the time when consumer prices remain high. You can see why this is having such major problems in the retail and fast food space. But they're not the only ones. Stellantis now says, well, they got a problem as Jeep and Ram dealers are complaining that cars are sitting on their lots. And that shouldn't happen. If you think about a booming economy, people should want to buy cars. They should have access to credit. They should have the down payment. They should have the confidence to do that, but they're not. And many attendees, this would mean dealers, were frustrated with unsold cars and trucks piling up on their lots as inventory levels. And we talked about this with Tesla, that inventory levels were being a problem because we went from this issue there wasn't enough supply to what happened. Manufacturers around the world said, we'll give you all the supply you can handle, and they cranked up the assembly lines and demand started to fall out, but everyone bought into the narrative. They believed the political elites were right that we're going to see a booming economy. Did you believe that? I'd love to know. Make a comment below. And now what happened is we're seeing this shift here. Demand falling, supply increasing. And look at this, a 3-month supply of vehicles well above the industry average. And dealers told executives the company's resistance to lower prices. Again, that's not what you hear in an inflationary environment. Here you have the dealers telling them, you need to lower your prices. We have too much inventory. That's the problem. As we see prices remain high at Jeep and Ram, the two top selling U.S. brands at Stellantis, as rivals were offering deeper discounts as higher interest rates were inflating consumers' monthly payments. But everyone believes that inflation just keeps running out of control. And I've talked about this on the show, that when demand goes down, inflation comes down, and we're seeing that demand component drop off like a rock. And yet everyone believes that somehow everyone's going to continue to raise their prices. Well, if you can't sell your inventory, well, you have nothing to raise, and that's the problem here. Auto retailers say they want Stellantis to do more to ease the crunch of inventory. Some have seen their new car lots get so backed up, they're refusing to take shipments of new vehicles, not a sign of booming economy. And what happens next? Well, when you have lack of demand, well, you don't need employees. Lucid being one of those, are cutting 400 jobs, and the latest sign of stress for the EV market. Again, we talk about possible bankruptcy here, not just at the consumer level. You're talking about potentially companies failing due to high debt loads and not enough sales. You can just see this spiraling out of control during the next financial crisis as layoffs underscore the challenge for EV makers. Well, it's not the only ones here, as production, while adapting to an environment of a waning consumer, there's key here. They're saying it's waning for demand of battery-powered vehicles. Well, Stellantis is saying it's demand for their vehicles too. An EV market, Tesla announced last month, as we talked about, a cut of 10% of its workforce, while Rivian has multiple instances of layoffs this year, putting more and more people headed onto the unemployment line. Once they run out of their severance, it's going to be dangerous. And you start to wonder then why U.S. consumers tempered inflation expectations in late May, as we now look to the University of Michigan Consumer Confidence Survey. And well, there was certainly a lack of it, and for good reason, as consumers expect prices will climb at a 3.3% annual rate over the next year, down from the 3.5% that was expected. And why would that happen? Because they already know they're spending less. And if they spend less and their neighbors spend less and everyone else spends less, price growth is indeed coming down. They see costs rising 3% over the next 5 to 10 years, but that's, well, not likely to happen. And part of the improvement may reflect a steady easing in gasoline prices over the course of the month. Well, you can see the relationship here. The University of Michigan inflation expectations in blue against U.S. regular oil formations gas price in red. You might as well just throw away the University of Michigan survey and just call it what it is. It's gas prices where people get their claim of what inflation is, but we do know that as gasoline demand declines, which we're seeing some early signs of, that inflation too will go away. And while the university's final May consumer sentiment index improved from the preliminary reading, it still registered a notable 8.1 point decrease from April, which is massive, and stands now at a 6-month low of 69.1. And this is on the cusp of the second half of the year. What did we hear? Second half rebound, no landing, soft landing. This was it. Right up to the end, we're going to see a massive surge in spending. Consumers now saying they're completely lacking confidence, and for good reason. When we look again back at total compensation shown in blue against the University of Michigan Consumer Sentiment Survey in red, what do we see? Deceleration in total compensation, eventually a deceleration in confidence. You can't blame people. It makes sense when your paycheck relative relative to what you need to buy starts to shrink. Your confidence goes down. Your spending power goes down. You can see that happen here leading into the dot-com bubble, leading into the global financial crisis. And right now, because you can see consumers bought into the narrative, the economy was going to boom, and the confidence went up as their compensation went down, and now all of a sudden it's shifting in a big way as they realize the facts of the economy is far weaker than actually anybody at the top wants to recognize. They see demand going away. They see what's going on in their businesses. Hours worked are getting cut. Compensation pay is not increasing fast enough. Consumers realize what's coming, and they're cutting their spending in response. In addition to high prices and borrowing costs that are raising concerns about the cost of living, response in the survey grew anxious about the labor market. And that's a key point, because when you start to see demand go down and you're at work and you see a lack of new orders and you don't have a lot of backlogs of orders, you start to see idle workers, and companies start to cut hours. And then after they cut enough hours, they start to cut heads. And even worse, if you have a friend on the unemployment line, they can't find work, you start to worry what happens if you get there. That's why consumers start to cut their spending, increase their savings rate. They expect the jobless rate to rise and income growth to slow. That represents a challenge for President Joe Biden, his bid for re-election. And absolutely, that is the issue we have raised repeatedly on the show. And you can see, sure enough, the University of Michigan consumer sentiment in blue against continued unemployment claims. And no doubt, when consumers find themselves on the unemployment line and they see there's a lack of jobs and potentially more of them getting on the unemployment line, which would make sense because if people are on a severance right now and they're running out of time on that clock, well, they're going to look to the unemployment line. They're trying to find a job, but they can't find one. That means their confidence is going to erode quickly. You can see each and every time consumer confidence drops, unemployment goes up. In terms of continued claims, we're going to see consumer confidence here drop like a rock in the months to come. And about 4 in 10 respondents now blamed high prices for eroding living standards because they don't realize it's just wages that are not increasing fast enough. Consumers also see less of a chance the Federal Reserve will lower interest rates in the coming year, as if people still believe in the magic of the Fed. Believe me, they can cut rates once or twice. It will make absolutely no difference to what's going on with the underlying economy. The current conditions gauge decreased 69.6 in May from 79 in the prior months. That's how consumers feel today. You see a big drop. A measure of expectations, that's future 6 months down the road, to 68.8 from 76. And when that happens, spending goes down. So consumers are saying, not only am I feeling less confident today, but I'm not buying into this economic rebound anymore. And when that happens again, spending decreases in a big way. And buying conditions for durable goods decreased to a one-year low, while consumers' perception of their current financial situation was the worst now in 5 months. And you want to talk about why Burger King, we mentioned their early warning of bankruptcies coming when they say that fast food is becoming a luxury, and we see these massive debt loads under companies. We know there's going to be a huge wave of bankruptcies coming in the point, probably later this year into next year, as we enter a very deep and prolonged recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.